Let us start with the broader context of auto ancillary market. In financial year 2024, the market was valued at rupees 6.14 trillion and it was projected to grow at a CAGR of 10.67%. More than 50% of the sales was from engine components, body, suspension and braking, and passenger vehicles and two-wheelers being the source of the major demand. Surge in domestic auto sales, consumer preference for tech, safety and comfort, government initiatives like Make in India, Digital India and production-linked incentive schemes, export boost via low-cost manufacturing and skilled labor, these were the major growth drivers. A significant shift is underway with the rise of electric vehicles. Electric vehicles currently make up around 8% of all new vehicles sold in India. A figure that includes a high volume of electric two-wheelers and three-wheelers. However, because these categories have much lower price points than passenger or commercial vehicles, the EV market accounts for a smaller share of total industry revenue, estimated at US $8.49 billion in 2024. This is roughly 3 to 4% of the total US $240 billion automotive market. It is expanding rapidly, projected to cross US $117 billion by 2032, growing at a CAGR of 22.4%. To drive this transformation, the Indian government has outlined ambitious EV adoption targets for 2030. 30% of the private cars, 70% of commercial vehicles, 40% of buses, and 80% of two- and three-wheelers are going to get converted to electric vehicles. The status of EV penetration as of 2025, for two-wheelers it is 1.05%, three-wheelers 46.43%, four-wheelers 0.93% and buses 0.96%. It is clearly evident that the maximum penetration has been in the category of three-wheelers. To achieve these EV goals, the government has introduced several critical policy measures. The FAME India scheme provides a direct incentive for EV adoption. The product-linked incentive scheme promotes local manufacturing of electric vehicles and key components. The Advanced Chemistry Cell Program supports the development of indigenous battery storage technologies. PM E-Drive scheme supports infrastructure for E-two-wheelers, E-three-wheelers and E-trucks. PM E-Bus Seva aims to add 38,000 plus e-buses. These policies aim to reduce import dependence, boost domestic value addition, and establish India as a global EV and component hub. Despite growth potential, challenges like inflation and margin pressures exist. However, localization, EV trends, and technology-driven innovations present massive opportunities. Let us now have a look at the business snapshot of Sandhar Technologies. Sandhar Technologies is a small cap company which was established in 1987 and headquartered at Gurugram, Haryana with 11,000 plus employees. It is focused on original equipment manufacturers and special safety and security systems for vehicles. It has a diverse product portfolio ranging from automotive locking systems, vision systems, die-cast components, structural parts, stamping, operator cabins, optoelectronics, tooling, helmets, rims, handlebar units, fuel pumps, filters, wiper blades, and serves two-wheelers, passenger vehicles, commercial vehicles, off-highway vehicles, tractors, and non-auto sectors as well. Its key customers include Hero, TVS, Tata Motors, Ashok Leyland, Volvo, and it is also expanded to include Caterpillar, Mahindra & Mahindra, SML Isuzu, and so on. Sandhar Technologies has also strategically expanded into electric vehicle component segment, positioning itself as a key enabler of India's shift towards clean mobility. The EV division was initiated in January 2022, with project development starting in April 2023. And the first commercial sale was achieved in July 2024. So this marks a focused and timely entry into one of the fastest growing areas in the automotive sector. Sandhar's initial EV product lineup includes motor controllers, battery chargers, and DC to DC converters. So these components are specifically designed for two-wheeler and three-wheeler electric vehicle OEMs, which represent the most rapidly electrifying segments in India. Serial production for these parts is planned from August 2024 through September 2025. Now, what makes this particularly significant is that these components, that is the motor controllers, battery chargers, and DC to DC converters, are fast moving, high demand parts. Every electric vehicle, regardless of category, depends on them for core functionality. Their applications are not only mission critical but also highly standardized, making them attractive to OEM customers. In India, demand is further amplified by fleet electrification, government incentives, and OEMs seeking localized cost effective suppliers due to import substitution trends. To enhance its technical edge, Sandhar has partnered with Sandhar Technologies for battery chargers and Amber Root systems for motor controllers. These collaborations allow Sandhar to offer in-house design and production with quicker turnaround and better IP control, which are obviously key advantages in a supply constrained market. So looking forward, the company is developing next generation integrated electric vehicle systems such as a 3-in-1 motor controller, a combined charger converter PDU system, and an isolated DC to DC converter. So these innovations reflect a shift towards compact, modular, and cost-efficient solutions, perfectly aligned with India's growing EV demand and OEM requirements. So in summary, Sandhar is tapping into high growth, high volume component market with scalable future ready solutions. So it's well positioned to become a trusted EV partner for OEMs across India and beyond. Let us now have a look at the operational presence of Sandhar. In India, it has 37 manufacturing facilities across 8 states. These are strategically located close to major original equipment manufacturing hubs to ensure supply chain efficiency. Globally, Sandhar operates in Spain and Poland, supporting its strategy to serve international OEMs and scale operations effectively. Let us now examine the key financial metrics for Sandhar Technologies. On the day of recording this video, that is 22nd May 2025, the company is listed on both Bombay Stock Exchange and National Stock Exchange with a market capitalization of 2,706 crores. The current market price stands at rupees 450, which is comfortably above its 52-week low of rupees 315. Though it is still below the 52-week high of rupees 698, now here there is some room for potential recovery. The stock trades at P ratio of 20.1, reflecting a reasonable valuation compared to sector averages. The book value, rupees 177, gives us a price to book ratio of around 2.54, which is, I'll say, a moderate value given the stock is a manufacturing stock. On the return front, the company delivers a healthy ROE of 11.4% and a ROCE of 12.1%. The dividend yield stands at 0.7%. So overall, these metrics reflect financial stability and the stock seems to be fundamentally sound. Structurally, Sandhar has 6 direct and 3 step-down subsidiaries, and it operates over 10 joint ventures with global partners focused on auto electronics and die casting. These joint venture partners bring specialized technologies from safety systems to connected vehicle components, greatly enhancing Sandhar's innovation capability. Let us take a moment to understand a key pillar of Sandhar Technologies' growth approach: its strategic use of joint ventures and technical collaborations. In today's auto industry, technology is evolving rapidly, especially in the areas like electrification, safety system, and connected mobility. Rather than trying to build everything from scratch, Sandhar has chosen a smart path. It partners with global leaders to bring specialized technologies into its portfolio. For example, through its joint venture with Jin Yong from Korea, it's basically a company from Korea, Sandhar now manufactures advanced relays and vehicle switches. Its collaboration with Honda Lock, which is a company from Japan, brings in expertise in smart locking systems and mirrors. Now, this joint venture strategy helps Sandhar in several ways. First, it gives them immediate access to proven global technology without waiting for years if they take the route to develop it in house through in house research and development. Second, it allows them to localize manufacturing in India, which aligns perfectly with the government's Make in India and PLI schemes, reducing import dependence while boosting margins. Third, these partnerships open doors to new customer segments and production categories. So instead of just being a mechanical part supplier, Sandhar is now active in high growth areas like vehicle electronics, sensors, and EV subsystems. And finally, joint ventures allow Sandhar to share both investment and risk while scaling up more quickly in competitive markets. Sandhar's technical collaborations, such as with Jin Yong and Honda Lock, enable it to manufacture advanced components like relays and smart door systems, boosting its intellectual property base. Now, speaking of intellectual property, Sandhar holds 25 patents with 10 granted. Key patents include anti-theft locking knobs and electronic handle locks. A patent gives Sandhar the exclusive legal right to manufacture and commercialize a specific innovation, protecting it from imitation by competitors. This not only allows the company to differentiate its offerings in a highly competitive market, but also creates a monetizable advantage through licensing, premium pricing, or exclusive supply arrangements, especially in areas like electric vehicles, where innovation drives OEM preference and export potential. Now, these patents are granted under India's Patent Act 1970, and they provide Sandhar with exclusive rights for 20 years, allowing the company to protect its innovations, prevent imitation, and commercially capitalize on its research and development. Here's how Sandhar compares with its industry peers. The company's offerings are broad, covering locking systems, filters, and wipers, positioning it well against bigger players. In peer comparison, while Sandhar's market cap is smaller, it maintains competitive price to earning ratio and ROCE levels. This suggests a good efficiency despite its scale. Sandhar distinguishes itself through its extensive product portfolio and strategic collaborations, which enhance its market position. While Sandhar holds a significant market share in certain product categories, it does not have a monopoly in specific product line. The automotive components industry is characterized by multiple players offering similar products, leading to a competitive environment. Sandhar's strategy focuses on innovation, quality, and partnerships to maintain and grow its market presence. Let us now take a look at the financial performance over the last 5 quarters. Starting with the sales, there's a steady growth reaching 1,014 crores in March 2025, a 11% year-over-year increase from March 2024. Operating profit peaked at 99 crores in September 2024 and remained healthy at 88 crores in March 2025. There is some pressure on the margins, with the operating profit margin easing from 11% in March 2024 to 8.7% in March 2025. Probably elevated input costs and higher operating expenses are the reason. On the bottom line, net profit improved to 42.6 crores in March 2025, up from 36 crores in the same quarter last year. This was supported by higher other income and effective tax management, with the tax rate declining from 28% in Q3 to 20% in Q4. EPS is also improved, reaching 7.10 in Q4 2025, the highest in the 5-quarter period. Overall, the trend underscores a healthy top-line trajectory and stable earning performance with some margin compression. Let us now have a look at the profit and loss summary over the last 5 financial years. Financial year 2021 was significantly impacted by COVID-19 pandemic, which disrupted operations and it led to subdued financial performance. So that being said, the rebound since then has been strong and consistent. Sales have grown from 1,864 crores in FY21 to 3,884 crores in financial year 2025, with a 3-year compounded growth of 19% and 5-year compounded growth of 15%. Operating profit side, we have seen a steady improvement from 177 crores in FY 2021 to 383 crores in FY 2025. Operating margins dipped to 8% in FY 2022, recovered to 10% in FY 2024 and FY 2025. Other income has grown significantly in FY 2025. Interest and depreciation expenses have increased due to expansion and capex. Profit after tax has more than doubled from FY 2021 to 185 crores in FY 2025. Effective tax rate has come down to 23%. And the profit climbed from 58 crores in FY 2021 to 142 crores in FY 2025. Reflects a 3-year compounded profit growth of 36%. EPS has grown strongly from 9.59 in FY 2025 to rupees 23.53 in FY 2025. Dividend payout has risen to 29%. Finally, growth and return metrics, I'll say they are encouraging. Let us take a look at the consolidated balance sheet over the last 5 financial years. Total equity has increased steadily from rupees 804 crores in FY 21 to rupees 1,139 crores in FY 25. This growth is mainly driven by the accumulation of reserves, while equity capital remained unchanged at rupees 60 crores. On the liability side, total borrowings have nearly tripled from rupees 310 crores in FY 21 to rupees 924 crores in FY 25. Other liabilities also rose from rupees 482 crores to rupees 787 crores, resulting in total liabilities of rupees 1,651 crores in FY 25. The rise in borrowings suggests a deliberate strategy to support expansion and capital expenditure. Overall, the company's balance sheet size has grown from rupees 1,596 crores to rupees 2,790 crores, making a compound annual growth rate of over 14% in total assets. On the asset side, net fixed assets have grown from rupees 842 crores to rupees 1,347 crores, indicating substantial investment in physical infrastructure. The CWIP peaked in financial year 2022 and gradually declined, suggesting the commissioning of key projects. Other assets have increased significantly, reaching 1,317 crores in FY 25, while investments have remained relatively stable. Overall, the balance sheet demonstrates a healthy expansion of the base, supported by both equity and long-term debt, pointing to a balanced approach in funding growth initiatives. Cash flow trends and key working capital metrics over the last 5 financial years. Cash from operations shows a significant improvement from rupees 49 crores in FY22 to rupees 308 crores in FY23, sustaining at rupees 275 crores and rupees 247 crores in FY24 and 25 respectively. This indicates strong underlying profitability. Cash from investing activities remained consistently negative, ranging from minus 241 crores to minus 310 crores. Cash from financing fluctuated over the period, with a notable inflow of rupees 260 crores in FY22 and rupees 101 crores in FY25, likely tied to external funding for expansion. Net cash flow turned positive in FY23 and reached 58 crores in FY25. From working capital standpoint, debtor days improved significantly from 77 in FY21 to 45 in FY23, but rose to 52 in FY25. Inventory days also trended downwards until FY24 before increasing slightly in FY25 to 63. Days payable declined from 131 in FY21 to 81 in FY25. The cash conversion cycle remained within a manageable range, increasing marginally from 22 days in FY24 to 34 days in FY25. Working capital days followed a similar trend, ranging in 27 and 47 days over the period. The company's return on capital employed improved from 8% in FY21 to 12% in FY25, reflecting enhanced efficiency in capital deployment. If we go through the investor presentation shared in the Sandhar Group homepage, the revenue snapshot financial year 2024-25, it reveals the breakup of the revenue. We can see that 88.4% of the revenue comes from the India business, whereas 11.6% of the revenue comes from the overseas business. There has been a marginal decrease in the overseas business from 13.9% in FY 23-24 to 11.6% in FY 24-25, whereas the India business has increased commensurately, that is from 86%, 86.1% in FY 3-24 to 88.4% in FY 24-25. Category wise, if we see, the majority of the revenue, that is 64% of the revenue, comes from the two-wheeler segment, whereas passenger vehicle segment contributes 16.7% of the revenue. Off-highway vehicle segment contributes 14.5% of the revenue, and the rest of the revenue comes from other vehicle segments. Compared to financial year 23-24, we can see that there has been an increase in the revenue contributed by the two-wheeler segment, whereas there has been a minor decrease in the revenue contributed by the passenger vehicle and the off-highway vehicle segments. Product-wise, if we see, 19.6% of the revenue comes from the locking systems, 5.6% of the revenue comes from vision systems, cabins and fabrications 13.6%, sheet metal 19%, aluminium die casting overseas 11.7%, aluminium die casting domestic 13.2%, assemblies contribute about 10.9% of the revenue, and 6.4% of the revenue comes from others. The investors presentation also provides this financial indicator snapshot for financial year 2024-25 on a consolidated and standalone basis. On the consolidated level, total income grew by 10%, increasing from rupees 3,531 crores to rupees 3,901 crores in financial year 25. EBITDA rose by 14%, reaching rupees 399 crores with a slight improvement in the margin from 9.9% to 10.2%. The EBT, earnings before tax, increased by 23%, moving from rupees 150.1 crores to rupees 184.59 crores, reflecting improved operating performance and controlled financing costs. Profit after tax, that is the PAT, registered a 28% growth, rising from rupees 110.26 crores to rupees 141.64 crores, with the PAT margin improving from 3.1% to 3.6%. On the standalone basis, total income increased by 8% from rupees 2,727.34 crores to rupees 2,936.28 crores. EBITDA improved by 14%, rising to rupees 300.45 crores, with the margin moving up from 9.7% to 10.2%, mirroring the consolidated trend. EBT rose by 21%, while PAT showed a 24% increase, reaching rupees 139.63 crores, with a net margin improving from 4.1% to 4.8%. Overall, the company has demonstrated consistent growth across all key profitability metrics, with healthy improvements in both margin and absolute terms over the prior year. Sandhar Technologies boasts a seasoned and visionary senior management team. It is led by founder, chairman, managing director and CEO Mr. Jayant Davar. He has over 4 decades of experience in auto ancillary space, and Mr. Davar has been instrumental in steering the company towards innovation and global expansion. He is actively involved in various industry bodies, including the Confederation of Indian Industries and Automotive Component Manufacturers Association. Now, this contributes to policy making and industry advancements. Supporting him is Mr. Yashpal Jain, the Chief Financial Officer and Company Secretary, who brings over 4 years of experience in financial management and corporate governance. The board comprises a diverse group of professionals, including independent directors like Mr. Vimal Mahendru, who is known for his work on sustainability and global standardization, and Ms. Archana Kapoor, with extensive expansion and international business. So this blend of experienced leadership and diverse expertise positions Sandhar Technology to navigate the dynamic auto industry effectively. Let us now have a look at the shareholding pattern. The promoters hold nearly 70% with no pledged shares. Now, out of these, Mr. Davar holds 54%. Now, this reflects the management's confidence and clean governance. The DIIs hold about 15%, and the retail investors hold 13%. The FIIs hold just about 0.69%. Now, there has been no major increase or decrease in the holding pattern of the DIIs and the FIIs, and the promoter holding also has been constant, so which is a good sign. Let us now take a look at the technical setup of Sandhar Technologies on the weekly chart. The stock made a 52-week high around rupees 681 and has since undergone a prolonged correction, bottoming near rupees 341 support zone. Recently, we observed a bounce back from these lows, and the price is now trading near rupees 450, showing early signs of trend reversal. Notably, this rebound comes after a sharp downtrend, indicating that buyers are returning at lower levels. From a momentum perspective, the RSI, that is the relative strength index, has recovered above 50 to 53.06. This level indicates the stock is regaining strength but is not yet overbought, which supports a positive near-term outlook. It has moved back above the neutral 50 mark, which often suggests a shift in momentum from bearish to bullish if RSI sustains strength. We also see increasing volume over the past few weeks, especially around 400 to 420 range, which reinforces the possibility of accumulation by market participants. On the MACD, the histogram has flipped positive, and the MACD line has crossed above the signal line. Both strong bullish indicators. This suggests improving momentum and potential for continued upside. Looking ahead, the next resistance lies around rupees 538, which also aligns with the previous support turned resistance. A breakout above this level could open the path back towards 600 plus zone. On the downside, key support remains at rupees 341, and a break below this could invalidate the bullish setup. So from a technical standpoint, the stock is showing signs of recovery with bullish crossover signals and strengthening momentum, which is aligning well with the fundamental improvements that we already discussed. Let us wrap up with a balanced view on Sandhar Technologies. First, the positives. Sandhar is positioning itself smartly for the future of mobility. It has already entered the electric vehicle space with key components like motor controllers, battery chargers, and converters. These are products that are fundamental to any electric vehicle. They have also partnered with technology firms like Denault, Amber Root to accelerate product development and strengthen in-house capabilities. What stands out is the commitment to innovation. With 25 published and 10 granted patents, Sandhar is focusing on areas like smart locking systems, security segments, and these are gaining more importance as vehicles become more connected and intelligent. Operationally, the company has a strong footprint with 37 plants across India and additional facilities in Spain, Mexico, and Poland. Now, this ensures access to both domestic and global OEMs. Financial performance also has been solid. Over the last 3 years, revenue has grown at 19% annually, profits at 35%, and EPS has more than doubled. From a valuation perspective, Sandhar is still trading at a discount to larger peers, which could offer upside for long-term investors. Now let's talk about Sandhar is a small cap stock, which makes it more volatile and sensitive to market sentiment. Its EV business, while promising, it is still in the early stages and may take time to scale significantly. The company also faces stiff competition from more established players like Uno Minda and Minda Core, who have larger research and development budgets and greater economies of scale. Its return on capital, which is currently at 12.1%, lags behind top-tier players, which is in the range of 18 to 20%. Additionally, Sandhar is in a heavy capex phase, investing in new manufacturing and research and development capabilities, which could weigh on short term cash flows. Input cost pressures, especially in steel and aluminium, could further impact margins. So, what's the takeaway? Sandhar isn't a perfect story, it comes with risks, especially in the near term. But for investors with a 3 to 5 year horizon, the opportunity is compelling. It's a company that is aligned with the major trends shaping the future of the auto sector. Electrification, that is, digital innovation, and global source diversification. So, in short, Sandhar offers a calculated way to participate in the India's automotive transformation, and the best rewards here will go to patient, forward-looking investors.